Manish joins in now to talk about the equity-based volatility fund at ICICI Pru. Manish, thanks very much for taking out the time to speak with us. How are you managing this fund, especially given the market volatility and weakness right now?
So for this fund right now, we are still underweight domestic cyclicals. Our view is that the macroeconomic situation is still very choppy, and it will take some time for the country to come out with high growth in the near future. So what we're doing is slowly removing our underweight on domestic cyclicals, but we're still maintaining our underweight right now. But apart from certain very high quality stocks, we are able to find some reasonable value out there. So we've kept a value bias to the fund, and we're kind of maintaining that broadly.
What's the mandate as far as managing volatility is concerned under this fund?
So we are increasing equity exposure. Just to step back, let me just describe the framework for this fund. Essentially, this fund keeps buying as the market keeps falling. Of course, in the context, we also have certain macro variables which reflect the state of the fixed income market on the equity allocation as well. But broadly, the idea being that as the market falls, we keep buying equities. So what has been happening over the past 2-3 quarters is we had been slowly buying mid caps because that was one category which was underperforming the broader market, and we were able to find a lot of bargains out there. Currently, even the large caps are offering value, so we are definitely increasing our equity allocation, and the beauty about the fund is now we are able to buy these very good companies at very reasonable valuations. So I would say that the fund's framework is working pretty well, and we are able to buy stocks at prices we wanted to.
Okay, in which case let's talk about some of the pockets which are stressed as well. Auto ancillaries definitely are, autos probably not so. What's the view here?
Actually, that is one of our big thematic ideas, more on the auto ancillary side rather than autos themselves. So we feel that among the cyclicals, autos is one of the better cyclicals to be in. There are 2-3 reasons for this. One is that these are unlevered plays, unlike banks and some infra companies. So you have some comfort that even in an adverse macro environment, these companies will be able to weather the storm. The second is slowly there's an export element to the industry building out there. If you go back 5-10 years, the exports of this industry have clocked a very healthy CAGR. So you're also getting diversity of markets. So stocks like Tata Motors, Motherson Sumi, etc., they're deriving fair amount of revenues from overseas markets. So that gives us certain hedge in terms of not being fully dependent on the domestic market as well. And 3 is valuations are relatively inexpensive compared to the state of the cycle we are in. So if you see in terms of passenger vehicle sales, in terms of 3-year CAGR, we are the worst in 20 years. So I think if at all there is a cyclical revival in the Indian economy, you are going to see segments like passenger vehicles bounce back pretty strongly. So net-net, the risk reward seems to be the best for this sector among the Indian cyclical sectors.
I see there's enough exposure to banks as well in this space. How are you looking at that theme, given the kind of badging we've seen for most of the stocks?
So the fortunate part has been that we've been underweight that sector and kind of concentrated in the high quality names. See, the thing with banks is these are very leveraged entities. So our view always has been that they will depend more on the macro than the valuations themselves. So while the valuations obviously are getting more and more attractive, and as I said earlier, we're kind of nibbling away and slightly increasing the exposure. But we're also cognizant of the fact that if you look at the macroeconomic risk to the country, they're pretty significant at this point of time. So broadly, we are underweight marginally right now, and frankly not in a big hurry to go majorly overweight there.
And finally, what sectors are a clear avoid for you, Manish?